Here in Unit 1, what we're going to be doing is really kind of creating this macro view of what the Forex market is and all of the different things that you need to know and put into place for you to step into a role of retail trader, and even more importantly, a consistently profitable retail trader. And so I call this the who, what, when, where, whys, and hows of Forex trading. And so we're going to step right up with the very first question of what even is Forex? So Forex stands for foreign exchange or foreign currency exchange. You'll also be hear it referred to as spot Forex, and you'll see it written as and referred to verbally as just FX. And Forex is the largest financial market in the world, and it has a trading volume of $6.6 trillion per day. And what you'll see in this graph, that even the Tokyo, London Stock Exchange, and the New York Stock Exchange all trade at a fraction of the volume that you have Forex up here at $6.6 trillion per day. So even the New York Stock Exchange trades and has $169 billion that passes through it every day, and Forex has $6.6 trillion that passes through it per day. And so this is really applicable and important to you as a trader. And I am on the very first slide bringing this out and going, let me give you a little bit of trading psychology right here and right now to save you a world of heartache in the future if you can wrap your mindset positively around this. That when you trade, when you place a trade as a retail trader, you are not moving the needle on that $6.6 trillion per day. Not even if you are with a group that trades certain signals or enters on a certain strategy or certain setup, or that trades certain pairs at certain times of the day, that there is not a bullseye on your specific back when it comes to the Forex market. And there's a lot of toxic mindset, a lot of toxicity and negativity personally between yourself and the market, and you're going to have to create and nurture your own positive relationship with yourself as a trader. And so you do not want to step out of the gate immediately feeling like, that the market is looking at you and that you're causing a shift one way or another way. You are not an institutional trader. You are not a market maker. You are a retail trader. And we'll go into this a little bit further in a minute, but truly psychology is going to carry you far and can also wreck your experience as a trading professional or as a trading hobbyist, no matter what you're looking for. But regardless, having a positive relationship with the market goes a long way to helping you be a consistently profitable trader, and that is our goal. Forex trading is the action of buying one currency against another currency when the exchange rate is at a specific dollar amount, and then selling it when it is at a different or another dollar amount. In its simplest form, or the simplest way you can explain it, is that if you ever travel out of the country where they use a different currency than your home country and you wanted some of that country's cash in your pocket, you would have to go to a currency exchange booth, usually at the airport, and give them one of your dollars in exchange for the equivalent amount of that country's currency. So the amount of currency that your dollar will buy is constantly changing, and you will be given the current exchange rate or the spot rate, which is the rate that your dollar is worth right at that moment. So if you were to travel, let's say, from the United States to Japan, you might want to exchange some of your American dollars for Japanese yen in order to pay for things that you would need cash for your trip. And so let's say, in order to do that, you would go to the exchange booth. And in this example, for every one of your American dollars, let's say that they give you 100 yen. and you stay there in Japan for a while and you end up not spending that cash. And so you get ready to return back home to the United States and you say, oh, I need to return that yen that I didn't spend and exchange it back for US dollars. And let's say when you go to the currency exchange booth, they tell you that the exchange rate has changed and currently your 100 yen is now worth $1.20. Now you originally gave $1 for 100 yen and then you gave that 100 yen back and you're now getting $1.20 for every 100 yen. And so congratulations, you just made a 20% increase on your investment by participating in the Forex market in its simplest form of buying and selling one currency against another. And now in this example, your investment increased by 20%. And in trading Forex, we're able to trade currencies without physically traveling to another country, and we instead place our trades or exchanges through brokers. But you have to keep in mind that your exchange rate could have just as easily been that when you traveled, you gave them your American dollar and they gave you 100 yen upon entering Japan, but then when you go to leave and exchange that 100 yen that you didn't spend back, that the current exchange rate was then only 80 cents US dollar per 100 yen, and then now you would have lost 20% of your original investment. So that is the part of the risk of trading and exchanging foreign currencies. The rates are always shifting and changing due to many influences, and you are never guaranteed which currency is going to be the stronger of the two, causing the exchange rate on that side to increase. Another example of usage of the Forex market would be when a company or an entity in one country wants to purchase something of value in another country. They would need to exchange the currency in their bank to the currency at the bank in which their payment to the seller is going. And this is a real simplified example, and some of the steps can vary depending on the circumstances or situations. But for our understanding, we're going to have this example, and we're just going to say that a tech company, let's say located in San Francisco, California, in the United States, decides that they're expanding and they want to create a new AI component division in their company. And so now they've negotiated to purchase a company headquartered in Dublin, England, in the United Kingdom. And the negotiated price for the purchase is 140 billion American dollars. So to facilitate the exchange of the 140 billion US dollars into the United Kingdom currency of the pound sterling, the buyers would contract with a broker to make the exchange from the buyer's bank of US dollars into the seller's bank of the pound sterling. Now, there are many factors that kind of come into play and are considered when making this exchange, one of which is the buyers wanting to get the most out of every dollar they have agreed to pay. So they want every US dollar to equal the highest amount of sterling as possible. In addition, that large of an amount of money cannot be folded into the market in a one instant or 1 second. And so they usually place different orders within an order block of prices in the market to slowly fold that money over in a period of time as the exchange rate bounces around within that range of prices until the entire 140 billion in US dollars has been exchanged and deposited in the pound sterling in the seller's account.